The celebrated investor who amassed a fortune by accurately forecasting the economic downturn of 2008 has ceased operations of his investment firm. On the 10th day of November in the year 2025, Michael Burr's entity, Scion Asset Management, formally concluded its registration with the Securities and Exchange Commission. This development transcends the typical closure of a financial fund. It signifies the departure of the very individual who foresaw the perils of the subprime mortgage scheme when widespread optimism prevailed. He amassed personal gains exceeding $100 million while financial institutions crumbled around him and has now opted to completely withdraw from the financial arena. Herein lies what warrants our profound consideration. Burr informed his clientele on the 27th of October that his assessment of securities' value has not, and indeed has not for a considerable duration, aligned with prevailing market sentiment. Ponder the implications of this statement. The individual who precisely predicted the most significant financial upheaval of our era is articulating that the underlying financial arithmetic is no longer sound. However, the situation intensifies and becomes considerably more compelling. Burr's most recent regulatory filing, a Form 13F for the third fiscal quarter of 2025, unveils something truly remarkable. It discloses his holdings of put options valued at $912 million against Palantir and an additional $186 million in similar instruments targeting NVIDIA. These represent substantial wagers that these highly touted artificial intelligence companies are poised for a dramatic decline. Furthermore, these are not short-term speculative plays. His investment positions extend through the years 2026 and 2027, strongly indicating his conviction that this market correction will be profound and sustained. To gauge the degree of Burr's certainty in his perspective, consider his public assertion that technology corporations are manipulating the depreciation schedules for their artificial intelligence infrastructure. This practice, he claims, serves to artificially inflate their reported earnings. This is far beyond mere market commentary. It is a direct accusation of systemic accounting fraud spanning the entirety of the technology sector. When an individual possessing Burr's unimpeachable track record makes such assertions, they cannot be casually dismissed. Now let us examine what renders this strategic maneuver entirely without precedent. Burr is transitioning to a family office structure, a move that effectively liberates him from the obligation of public disclosure. Following the month of November, his investment portfolios will become entirely opaque to the public. He is effectively disappearing from view precisely as the financial markets are reaching their apex. In a final communication on his social media platform prior to his public silence, he offered a cryptic hint onto much better things. This occurred on the 25th of November. This marks only the second instance in Burr's distinguished career that he has voluntarily dissolved his fund while market indicators were still on an upward trajectory. The inaugural occasion was in 2008, immediately preceding the near-total collapse of the global financial system. At that juncture, he executed his now legendary strategy of betting against the subprime mortgage market. While he was widely derided as irrational, his fund delivered an astonishing 489% return in the year 2007. He personally realized profits exceeding $100 million and subsequently shuttered his operation just as the real estate market attained its zenith. Consider the profound irony inherent in this situation. While the S&P 500 index hovers near its all-time highs, and stocks associated with artificial intelligence continued their seemingly unstoppable ascent, the very individual who accurately predicted the last major financial crisis is asserting that generating profits in the current market environment has become an impossibility. This is not an indictment of his acumen, rather, it is a potent commentary on the state of the markets themselves. What we are observing is akin to a grandmaster chess player withdrawing from the game, not due to defeat, but because they perceive a fundamental alteration in the very nature of the contest. When an individual who has accumulated billions by discerning illusory financial trends informs us that the disconnect between market valuations and underlying reality has become absolute, this transcends mere investment guidance. It constitutes a stark warning about the integrity of the entire economic edifice. The pertinent question that every investor in America ought to be posing to themselves at this precise moment is remarkably straightforward. If Michael Burr is incapable of profiting within these markets, what does this foretell about the future trajectory of economic events? What most investors fail to grasp is that the voluntary liquidation of renowned fund managers during periods of market peaks is not a mere coincidence. It has consistently served as the most reliable harbinger of an impending economic collapse in the annals of American financial history. On each occasion that a preeminent investor has disengaged, citing the irrationality of market dynamics, a devastating financial cataclysm has ensued within 18 months. Let us commence with the progenitor of this pattern, Jesse Livermore. In 1929, Livermore stood as the preeminent trader of his epoch. He was the man who profited handsomely by short selling during the 1907 panic, amassing $3 million at a time when such a sum could have purchased half of Manhattan Island. By September of 1929, while the rest of the nation reveled in the prosperity of the Roaring Twenties, Livermore quietly divested all of his long positions and began strategically betting against the market. His associates deemed him to have lost his faculties. The Dow Jones Industrial Average had tripled in value since 1924, and everyone was experiencing financial gains. Nevertheless, Livermore persistently communicated to anyone willing to listen that the market had become detached from intrinsic value and was inexorably destined for a collapse. His pronouncements were not driven by emotion, but by a rigorous analysis of the mathematical impossibility of stock prices that had completely divorced themselves from corporate earnings. On October 24, 1929, the market experienced a catastrophic downturn. By 1932, it had plummeted 89% from its peak. Livermore amassed $100 million by shorting this collapse, a sum roughly equivalent to $1.5 billion in today's currency. While countless Americans faced financial ruin, the individual who perceived the impending crisis early on secured generational wealth. Fast forward to March of 2000, and we witness an identical pattern unfolding. Julian Robertson, the architect of Tiger Management, had consistently generated average annual returns of 31% over a span of 20 years, a testament to one of Wall Street's most exceptional performance records. His fund commanded assets of $6 billion, and institutional investors eagerly sought opportunities for allocation. However, in March of 2000, Robertson stunned the financial world by completely dissolving Tiger Management. His correspondence to his investors was characterized by an unvarnished candor. The current frenzy surrounding technology, the internet, and telecommunications bears no resemblance to rational investment principles. He found himself unable to compete with speculative fervor as he steadfastly refused to abandon fundamental analysis in favor of speculative trading. The financial media subjected him to intense criticism. CNBC branded him an anachronism, incapable of adapting to the new economic landscape. Technology executives publicly ridiculed his traditional approach. Investors, driven by speculation, diverted billions from value-oriented funds to pursue internet stocks that lacked any revenue, let alone profitability. Merely 1 month later, the Nasdaq index reached its zenith at 5,048. By October of 2002, it had cratered to 1,114, representing a 78% decline that eradicated $5 trillion in market capitalization. Companies such as Pets.com, which had expended vast sums on Super Bowl advertising, were forced into bankruptcy. The purported new economy, heralded as a transformative force, was revealed to be built on little more than marketing hype and wishful thinking. Robertson's assessment was accurate, but his timing was precisely 1 month premature. In markets where momentum eclipses quantitative analysis, being early and being incorrect manifest indistinguishably until reality inevitably asserts its dominance. Now let us revisit Michael Burr's initial foray into the markets. From 2005 to 2006, during a period of escalating housing prices and widespread issuance of subprime mortgages, Burr was discreetly acquiring credit default swaps on these mortgage-backed securities. His investors expressed strong dissent, attempting to withdraw their capital, alleging a decline in his analytical prowess. The established financial community ostracized him. Banking executives dismissed him as delusional. Real estate professionals maintained that property values invariably appreciate. Government officials reassured the populace that subprime lending facilitated broader access to home ownership. Even his own investors initiated legal action to reclaim their funds. However, Burr had meticulously examined the data. He had scrutinized the mortgage documentation, analyzed the creditworthiness of the loans, and discerned that the entire housing market was underpinned by fraudulent lending practices. In 2007, his fund yielded an extraordinary 489% return. He personally garnered in excess of $100 million. He then proceeded to close Scion Asset Management at a time when financial institutions were still projecting an image of stability. 6 months thereafter, Lehman Brothers experienced its collapse, and the entire global financial system teetered on the brink of implosion. The individual who had been universally condemned as irrational was in fact the sole purveyor of truth. This recurring pattern extends beyond individual investors to encompass institutional fund managers as well. David Einhorn, the principal of Greenlight Capital, who profited enormously by shorting Lehman Brothers prior to its collapse, dedicated the years 2020 and 2021 to issuing warnings regarding the speculative frenzy surrounding meme stocks and the distortions introduced into the market by Federal Reserve policies. While GameStop and AMC experienced dramatic price increases fueled by online sentiment, Einhorn consistently maintained that market valuations had become divorced from fundamental economic principles. Seth Klarman, who oversees the Bopos Group, managing $30 billion and widely regarded as one of the most prudent investors in existence, actually returned capital to his investors in 2020. His rationale was that the prevailing market environment represented one of the most challenging conditions encountered in his 4 decades of investment experience. The market subsequently rallied an additional 50% following his cautionary remarks. Nevertheless, the underlying fragility he identified never dissipated. The underlying mechanism driving this discernible pattern is as follows. When esteemed value investors are unable to identify profitable investment opportunities, it serves as a definitive signal that asset prices have become completely disconnected from underlying economic realities. Financial markets are propelled by 2 principal forces, fundamental value and speculative momentum. When momentum achieves complete dominance, the most astute capital recognizes that quantitative analysis becomes rendered ineffectual and consequently exits the market entirely. Every significant market downturn follows a remarkably consistent trajectory. Asset values escalate far beyond any justifiable valuation. Savvy investors begin divesting their holdings, while less informed participants continue to acquire assets. Eventually, the disparity between market price and intrinsic value reaches such an extreme that even minimal selling pressure triggers a cascade of compelled liquidations. The inherent tragedy lies in the fact that retail investors remain perpetually oblivious to the impending crisis. They invariably are the last to purchase at the market's peak and the first to initiate panic selling at its nadir. When Livermore issued his warnings prior to 1929, individual investors disregarded his counsel and sustained complete losses. When Robertson cautioned the market in 2000, day traders mocked his predictions and were subsequently wiped out. When Burr raised concerns about the housing market in 2008, homeowners denounced him as unpatriotic and ultimately lost their residences. This historical pattern is poised to repeat itself. Michael Burr is initiating the closure of his investment fund for the 2nd time in his professional career, employing language that is remarkably consistent with his previous pronouncements regarding market conditions. The sole discernible difference is the specific asset class driving the current speculative bubble. In 2007, it was the real estate market. In 2025, it is artificial intelligence. However, the fundamental mechanism remains precisely the same. Abundant liquidity from the Federal Reserve engenders artificial demand. Asset prices then detach from economic reality. Consequently, the most astute investors recognize the mathematical impossibility of the prevailing situation and extricate themselves from the market. What transpires subsequently has occurred repeatedly in the past, and its ramifications have consistently been dire for those who chose to disregard the warnings. So, what compels Michael Burry to perceive the current market environment in 2025 as mirroring that of 2007? The answer is intrinsically linked to his substantial bearish investment positions and a core belief system that should instill apprehension in anyone holding technology stocks, particularly those associated with artificial intelligence, within their retirement portfolios. Burry's put option position, valued at $912 million against Palantir, is not a transient trading strategy. It represents a profound declaration of opposition to the entire artificial intelligence market bubble. He is wagering that Palantir, which is presently trading at over 300 times its earnings, a stark contrast to the historical market average of 15 to 20 times earnings, embodies the same form of mathematical anomaly that subprime mortgages presented in 2007. Contemplate the actual implications of a price-to-earnings ratio of 300. This signifies that an investor is paying $300 for every single dollar of annual profit the company generates. At such a valuation, it would require 3 centuries for an investment to recoup its initial cost through earnings alone. This is not investing, it is speculation predicated on the fervent hope that another party will be willing to pay an even more exorbitant price in the future. However, Palantir is merely the initial indicator. Burry's $186 million wager against Nvidia extends all the way to 2027, suggesting his conviction that the entire artificial intelligence chip revolution is founded upon the same basis of accounting manipulation and readily available credit that propelled the housing bubble. Nvidia's market capitalization has reached a staggering $3 trillion, surpassing the entire stock market valuation of the United Kingdom. This is where Burry's accusation takes on a particularly grave dimension. He asserts that technology firms are deliberately misrepresenting the depreciation schedules for their artificial intelligence server infrastructure to artificially inflate their current earnings figures. In simpler terms, companies are expending billions of dollars on sophisticated computer hardware, but they are amortizing these costs over unrealistically extended periods to present a more favorable picture of their quarterly profitability than is actually warranted. If Burry's assertion holds true, it implies that the earnings figures used to justify these astronomical stock valuations are, in essence, fraudulent. Much like the mortgage-backed securities that appeared secure in 2007 because the underlying loan quality was not rigorously examined, the parallels to previous market manias are impossible to disregard. In the year 2000, companies lacking any revenue were valued in the billions because investors subscribed to the belief that the internet would fundamentally revolutionize everything. In 2007, housing prices doubled within a 5-year period, predicated on the widely held conviction that real estate values never decline. In 2025, artificial intelligence companies are experiencing substantial financial losses while their stock prices are skyrocketing, fueled by the narrative that artificial intelligence represents the definitive future. The narrative invariably remains the same. This time is different. However, the fundamental mathematics never deceive, and the current financial arithmetic is unequivocally signaling a period of extreme danger. Consider the broader market conditions that have facilitated the emergence of this speculative bubble. Akin to the period between 2005 and 2007, the Federal Reserve has inundated the financial system with an abundance of low-cost capital, creating an identical environment of easy credit that fueled the housing market frenzy. When the cost of borrowing is virtually negligible, investors are incentivized to pursue any asset class that promises elevated returns, irrespective of its underlying intrinsic value. The so-called Magnificent Seven technology stocks, Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, collectively command a market capitalization exceeding $15 trillion. This aggregate value is greater than the entire economic output of either China or the European Union. The proposition that 7 companies alone possess a valuation exceeding the combined economic productivity of billions of individuals warrants critical scrutiny. Does this scenario appear sustainable? Let us examine what typically transpires when speculative bubbles inevitably burst and identify who emerges as the victor and who succumbs to losses. The insiders invariably depart the market first. Corporate executives exercise their stock options and liquidate their holdings while retail investors continue their purchasing spree. Venture capital firms divest their stakes while pension funds eagerly load up on perceived growth opportunities. By the time average Americans comprehend the unfolding events, the sophisticated investors have already sought refuge in safer assets. The beneficiaries of the forthcoming market correction will be the same individuals who profited from the downturn of 2008, those who early recognized the discernible pattern and strategically positioned themselves defensively. Cash, gold, treasury bonds, and indeed, put options on overvalued technology stocks will serve as essential life rafts when the bubble finally deflates. The individuals who will suffer the most significant losses will be those who invariably bear the brunt of market downturns. Retail investors holding onto artificial intelligence stocks at their peak valuations, pension funds with excessive exposure to technology growth, and anyone who erroneously believed that this time is different, despite centuries of historical evidence to the contrary. However, there is a critical aspect that should profoundly concern every American citizen. Unlike previous speculative manias that were largely confined to specific sectors of the economy, this artificial intelligence frenzy has permeated the entirety of the market. Your retirement savings, your pension fund, your college education fund, all are heavily invested in these overvalued technology stocks. This is a consequence of fund managers feeling compelled to chase performance as the bubble continues to inflate. When Burry accumulated $100 million in 2008, it was because he astutely recognized the mathematical impossibility of the prevailing market conditions before anyone else and possessed the resolve to act upon his rigorous analysis. He is conveying precisely the same message in 2025. The markets have become fundamentally detached from economic reality, rendering rational profit generation an unattainable objective. In 1929, Jesse Livermore cautioned that stock valuations had become artificial and were destined for collapse. The majority of investors disregarded his insights and suffered catastrophic losses. In 2000, Julian Robertson warned that technology valuations bore no correlation to rational investment principles. The majority of investors ignored his counsel and experienced devastating financial setbacks. In 2008, Michael Burry alerted the public to the fraudulent nature of housing finance. The majority of investors dismissed his concerns and suffered immense losses. Today, Michael Burry is closing his fund and withdrawing from markets that he characterizes as impossible to navigate with any degree of rational analysis. History does not precisely repeat itself, but its echoes are undeniably present. The underlying pattern remains remarkably consistent. Exceptionally astute investors identify unsustainable market conditions, issue warnings about mathematical impossibilities, are disregarded by the prevailing crowd, and are subsequently vindicated when economic reality inevitably reasserts itself. The individual who accurately predicted the crisis of 2008 is now signaling a similar impending event in 2025. The only question of consequence is whether you will heed this warning this time, or if you will join the extensive roster of investors who learn, regrettably too late, that when legendary figures like Michael Burry choose to disengage from the market, they are not forsaking lucrative opportunities. They are actively averting impending disaster.